All right, so let's first talk about securities to be held to maturity. Remember what you're supposed to do there? I remember I went over that a couple weeks ago on the board on what those were. So remember, held to maturity is that we amortize the cost over the time. The reason I want you to know this is you may see some of these things like in the multiple choice. I'll work through some problems that will be similar to you, but I want you to kind of have a good idea of what this is. And where does it go? It goes into the balance sheet there. So remember those things there. I will also have this out available to you, so you'll have this. But remember, held to maturity, amortized cost. Remember when I put down the board up here? So remember that. This is the amortized cost. And we take that over the time. So the next one I want to talk about here is the trading securities. You guys remember what trading securities? Now, easy way to remember this is, and for the exam, is the trading securities is income statement. TS, trading securities, IS, income statements. Remember that, okay? That'll help you remember that, so TS and IS. So that will go to the income statement. Those unrealized gains or losses automatically go to the income statement versus the other one, which I'll talk about in a second here. So remember that. Also that the adjustments will also go in, remember it is a current asset, sort of typically a current asset. That would be a little longer, typically it's a current asset. All right, so the next one here is available for sale securities, AFS, OCI. So 3 letters, both. That's the easy way to remember it. AFS, OCI, other comprehensive income. All right, so remember that, the AFS, OCI, TS, income statement. Easy way to remember those things. I will, just so you know, be kind and let you guys have a note card, 3x5 note card, so you will have that too. But just to have that by memory too, that may help. So questions on these? Where they go? All right. Now one of the things that you'll also see in here is, this is back into the investments. Remember we worked on these things? So there's different classifications. We just went over some of those classifications, what they are. If you have less than 20%, so that could be held to maturity, it could be available for sale or trading securities, it could be all those things there. But it's less than 20% there. Remember that, less than 20%. We just do whichever those are that we have. Now, the significant influence is between 20 and 50%. Remember that, that's the equity method. Remember what the equity method is. And that is when we take in the investment, the net income, and then we also have those dividends that are taken out of that. So remember how that all works. And we'll do some problems that go on to that, but you may see questions on where does this fall into, the percentage or something like that. And then finally, the consolidation. We don't go deep into consolidation yet, but just know what it's about. Anything over 50%, that means you have a controlling interest. You control that company, and you're able to provide the decisions that happen with that company. Where here you have a significant influence. You can influence them, but you don't have absolute say on what's happening. So in consolidations, we talk a lot about more in advanced financial accounting, for those of you taking that class. So questions on this? All right, so let's move on to the next part here. This is very, very basic, but I want you to remember this because you'll see several questions on the exam that pertain to this here. So this equation especially, make sure you know that. So you have the face value times the interest, and remember the time to maturity. And you may use this also here as, and remember when you're doing interest, 5/12 or whatever it may be, remember how to do that. It's very, very simple, but don't forget how to do it. You guys want to get that? All right. Let's move on to the next part here. Now, you may see some of this too. Now, you probably saw this in some of your questions for the homework. Remember how this falls. Now, if you can't estimate it, obviously you're not going to be able to do anything. It's basically disclosures only if you can't estimate those things. If it's reasonably possible that you can, need to know exactly if there's a probable likelihood of it happening. Reasoning possible and remote. Obviously remote we don't really care, we just put it in there. If it's a little past remote, we can put it in there, but typically you don't even put it in there. There's closures because it's not needed, because the chances of it happening are small. But if it's reasonably possible, then you then put in disclosure notes pretty much in everything. And then probable here, you will try to disclose that as much as possible. You'll try to improve the liability if you can know what that is, the liability is going to be. So remember those things, those loss contingencies. I'll give you a moment to get that down. All right, and also know this too. Pretty simple, but just remember what it's a discount. If it's below the market rates, equal to, and then above. Just kind of know that general information there. Remember, as you're looking at this, below the market rate, you need to provide an incentive for them to buy it. Otherwise, why would they buy yours? So you got to give it a discount because they can get a better rate somewhere else. So you give a discount. Obviously, if it's equal to the rate, then it's face value. Pretty simple, easy stuff. And then a premium, you want to get a little more for it because you're giving a little better interest rate. So you should get a premium for that. Just got a couple more slides, and then we'll start working on some problems here. All right, this one I'm just going to walk you through real quick. You guys remember how to do this, right? So walk you through this. This is the 12% bond rate. This is the yield rate, the current yield rate for the market. So remember what you're going to take there. You're going to take on the interest. You take the yield rates to figure out what you have. That's what you look at the present value table. The only time you take the stated rate is when you figure out what interest can be paid to you. So that's how they got the $42,000 here. There's 12% of, now remember it's 2 payments of that, so they divided by 2. So 12% of 700,000 was 84,000, divided by 2 because we're 2 in a year, that's 42,000. That's how I get it. Only time you're using the standard rate is to get this. The rest of it is yield. Remember that as you're working through these. And remember the difference between semi-annual and annual. Cut that in half. And remember that as you're looking at that. So I'll give you a moment to kind of get some of this down. But definitely know how to do this. You'll see this on stuff. A couple of problems we're working on, and then you may see it in a multiple choice also, somewhere also on that. Now, remember this slide from the other day. I want you to know these things, get these things down here, because you may see a question of what do you include as part of that when you amortize it. What's the cost of that bond? So you want to make sure that you have most of these ideas here. There may be some other things that are not always on here, but may be similar to those. Maybe like it's a CPA fee or something like that that she had to do as a part of that. That may be something you want to have. Remember that may be included as part of it. Just know that if it's similar to these things, include it. Because it may not be exact in the questions, but just be aware. give you another moment or so to get that down. Those jump into some problems. Thank you, Greg. We have one more. Are we good? Yes.
What are some examples of things that would be considered to be similar to it?
Basically, when you're talking legals, the registration for that, putting that out there, basically it's those things there. It's just that maybe somebody else would do it for you instead of, when it says underwriting, well, maybe a CPA firm did the underwriting for you.
Okay.
Or something like that. That's all. I mean, it may be similar to that. Is what I mean. Yeah. All right. Last thing here is the installment notes. And remember this amortization table? Nice thing, I didn't put a memorization table on that before. So because we have so little time, I didn't figure that the amortization table would be a good thing to put in there. I don't think we'd have enough time on your test. So I pulled it out. But the reason I put this up here is I want you to know, because there may be a question saying, what happens with the interest and the payment principal as you go along? Does it go up or down? Or how's it work? And so you may need to know some of those things there. So that's why I'm adding this in here, even though you won't have an amortization table in the test. But if you know how to do it, it's very helpful. So be happy you don't have one of those. All right, so what we're going to work on is a few problems here. Now, if we finish those, I have another one I may add in there with a little bit of amortization, but all right. So these are the 3 or 4 problems I want you to work on. I'm going to give you about roughly about 15, 20 minutes to work on these, and then I will go over these with you. And I want you to spend some time working on these. So it's EX 12-15, 12-14, EX 13-1, and 14-7. I'll pop the page numbers up there for you. Actually, it's just E. Yes. All right, so go ahead and work on those. You're welcome to work together. I recommend it. That way you guys can flip things off of each other. And then we will go over all of these, like I said, in about 20 minutes or so.